component manufacturer Sansera Engineering has posted a mixed set of Q4 numbers. The miss has come in on the margins. Margins at 15.3% is lower than what the street was anticipating. We're now joined by Mr. Preetham, the Group CEO of the company. Thank you very much, sir, for joining in. Can you talk about the margin pressure? Margins have declined both on a quarter-on-quarter and on a year-on-year basis. What led to the decline, and what is the outlook on margins going ahead? Where do you think FY24 margins would be at?
Hi, good afternoon. Thank you for having me on the show. Yeah, we have had a very good year in terms of our growth profile. Revenue growth has been quite good, despite the fact that the export market, we had pressure as we had declared in the beginning. So overall, when you see the product mix, our export delivers us a much better gross margin and EBITDA. So obviously, when there is a reduction from 37% to 28%, there would be some reduction in gross margin. But primarily on the Q4, we have accounted for a one-time expenses which is not pertaining to that quarter. So the approximately about 1% gross margin is affected by that, which translates to about 0.25% on a year-on-year basis. So we would have crossed 17% if that is taken into consideration.
Okay, so Mr. Preetham, in that case, since we are talking about this adjustment, the export market not doing so well, and that's why the higher gross margin contributing geography has not done so well. What about FY24? Are exports coming back to normalized levels? In that case, what would your margins look like?
Yeah, look, see, our Q4, if you look at our product mix, there was already a signs of recovery over the full year. If you had seen our international contribution was about 28.5%, but on Q4 it was around 31%. So we expect that both domestic and exports to do well this year. And we expect that we should be around 32 to 32.5% on a full year basis. So which means that our gross margins will also see a improvement over the current numbers.
And what about EBITDA margins, sir, this year?
We are looking at, see, we have always said that our EBITDAs will be range bound between 17 and 20%. We expect that we should be in the middle of the band towards this year.
Okay, so top line growth of 30 to 32% and margins between 17 to 20%. And exports have already started picking up. The export contribution has risen to 31%. You've given us a guidance over the long term. I was looking at your press release. You're targeting 60% sales from auto ICE, 20% each from non-auto and the EV tech agnostic segments. When do you think you will be able to achieve it?
See, if you, in FY21, our contribution from non-auto and tech agnostic and XEV was around 17%. This year we have clocked, we have improved it to 22%. And in FY24, we are expected to reach around 28%. So we expect that in another 2 years' time, by FY26, we should be comfortably able to achieve our vision of 40%. Though we have set ourselves 5 years, we should be able to do it slightly in advance than our plans.
So 40% from auto ICE by FY25 is what you're planning?
No, it's the other way. 60% would be from auto ICE and 40% will be from non-auto, tech agnostic and XEV.
By FY25 itself. Okay, we get that point. What will the contribution from aerospace and defense going forward be? Because you did have a new plant being constructed at Bengaluru, which has 4 times the capacity. How did it contribute in Q4? What is the contribution expected going forward?
See, this year we ended aerospace at around 90 crores. So in Q4, it was very close to 5% contribution to the revenue. Going forward, we expect aerospace to grow at 50% plus rate for the next couple of years. We have confirmed order books for that. This new facility of ours, when it is fully executed, would contribute about 350 crores of revenue, which we expect in between FY26 and 27, we should be able to achieve those numbers from that plant.
And when that takes place, when you do achieve about 350 crore of revenues from aerospace and defense, what would the contribution rise to?
No, we don't expect, because our other sectors are also growing pretty healthy. So we expect that it will be between 6 and 7% of overall contribution coming from aerospace alone.
From aerospace will be 6 to 7%. Are there any margin differences between different segments, Mr. Preetham? Just trying to understand, once this segmental shift takes, the shift takes place by FY25, will that see a change in your margin profile as well? Will it go higher than the 17 to 20% band that you're talking about right now?
Yeah, there are two aspects to it. One is our exports doing well. Certainly, your non-auto, most of it is going into the exports, and the export as a segment doing well will definitely have an advantage in terms of margin. Our gross margin difference between export and domestic is about 10%, which translates to between 6 and 6.5% of EBITDA differential between domestic and exports. So when we see an export mix going up, obviously the margins, overall margins, will also go up. And another factor to be considered is, today, because of weak two-wheeler performance, our utilization has not been great in the last 3 years on that. So we expect that this year the utilizations are better. We are also adding customers and products into it so that to improve our utilization. So we do expect that once both these factors come into play, we would be able to do better than the expected margin levels. Yes.
You've given us an order book number, which is, I think, close to about 1,100 crore rupees thereabout. What percentage of that comes in from exports? Because your whole margin recovery thesis rests on exports picking up.
More than 50% is exports, and my order book is about 13.3 billion rupees as of 1st of April. And this is post-reset. See, we do a reset on every 1st of April when all the new components which have already started mass production, we remove out of the order book and reset it. And this order book does not constitute any orders which are from replacement business. So this is a pure new businesses which are adding, which is not currently contributing.
And one more question, your debt reduction plans? Your debt is 650 crores.
We do not really expect a big change in our debt numbers, as our growth profile is quite steep. And we have aggressive plans for growing. We do expect that the ratios, net debt to EBITDA and net debt to equity, to have a improvement. But on a total overall debt numbers, we do not expect a big change. We would be around the same number.
Okay. All right. Mr. Preetham, it was a pleasure speaking with you, sir. Thank you so much for joining us and explaining to us what happened in Q4 and, more importantly, what's the outlook for FY24 going ahead. That's Sansera Engineering. Strong guidance going forward for the company. The stock up around 0.4%. We'll do one thing, slip into a short break. Up next,